Get to one of our main stories today, the impact of the Fed's 10th rate hike in a little over a year. The central bank dropped hints the current tightening cycle is at an end. Joining us now on that and the debt ceiling drama, Roger Altman, founder and senior chairman of Evercore. Roger, great to have you here. You think
Thanks
the Fed did the right thing? Has your opinion changed at all, seeing the continued turmoil that we're seeing in regional banks?
I think that the Fed did make the right decision, Melissa, for two reasons. First, everybody knows inflation is still running too high. It's running about 4.5% using the PCE deflator. It's just too high. So for the Fed to have stopped relative to that, I think would have been a mistake and would have undermined confidence and actually would have been a very negative result. Secondly, if the Fed had paused, I think the implication would have been the banking turmoil is much worse than all you guys think. And I think that would have been destabilizing from a market point of view, and the Fed knew that. So for those two reasons, I think it made the right decision. We'll see, based on the data, as they said in their statement, whether this is the end of the hiking cycle or it isn't. But I think, as far as yesterday is concerned, right move.
It's weird that you think two psychological effects would be more destabilizing than the actual move itself. In other words, the 25 basis points, all these marks on the duration mismatches, you got another, and T-bill yields, and anything that is causing deposits to flow out of regional banks is going to be exacerbated by another hike of 25 basis points. But you're saying that just because the Fed would look like they knew something psychologically, or just because it would look like their resolve for inflation is being, both of those things are psychological reasons.
Well, I'm not sure the first one is psychological, because look.
Well, how do we even know about the lag effect, Roger? How do we know inflation's not, given what we've already got, especially with the credit contraction, how do we know inflation's not already headed at 2?
We don't. We don't. And in fact, our view on the research side of Evercore is that we are going to have a moderate recession in the second half of the year. Then inflation by the end of the year will be around 3. And that by the middle of 2024, and perhaps a little earlier, it'll probably hit the Fed's 2% target. But I think for the Fed to have stopped and said, we've done it in terms of inflation, I don't think that would have been the right decision.
Because they were so bad on the way in. They messed up.
Yeah, they were so late on the way in. And if you step way back.
That's not a good reason to go too far now.
Well, wait. If you step way back, look, the Fed's had a tough year. They really have. Probably the worst year in the history of the Federal Reserve System, because they misjudged inflation. Then a few months later, they gave markets reason to think they might pause or pivot. And they've been playing catch-up for so long. For them to have stopped yesterday and then turned out to be wrong, and they could have been wrong in terms of inflation not trending down in the what direction everybody wants. I mean, that would have been catastrophic.
Yeah, how about having to cut a month from now because of making things worse? That's happened. You've seen that happen in the past.
I know. I agree with your previous guest, though. I think anticipating short-term cuts, I don't think that's likely.
How much do you think the credit tightening that we are seeing, that we are about to see from the regional bank crisis, how much do you think that translates into in terms of tightening?
Well, I think the combination of QT and some of lesser lending capacity or willingness is relevant. And I'm not smart enough to know whether that's 100 basis points equivalent on the funds rate or what precisely number that is, but I think that is relevant, yes.
I mean, that's an order of magnitude. 100 basis points is a tremendous amount. So why would you take off the table a Fed cut later on this year? Because the Fed came out and said, if we were 100 basis points higher right now, you might say that.
Well, Melissa, I don't know that the Fed won't cut at all by year end, but the spread in the federal funds futures markets, as you were talking about earlier, between the Fed's official forecast of the funds rate at the end of the year, which is in round numbers 5.25, and the futures markets forecast, which is up to 100 basis points lower than that, depending on the day, that implies a series of cuts. That I doubt.
Roger, a lot of people on strange bedfellows always in politics. I was watching Senator Elizabeth Warren was on our air yesterday, and I found myself nodding like a lot, and so then I just pulled myself away for a second and slapped myself a couple times. But I really was agreeing with everything she was saying about the Fed. This is no way, to putting people out of work is no way to try to improve an economy. Trying to slow the economy, I mean, that's the only tool they have. But in a perfect world, you'd wish you had something better than what the Fed is trying to do. And when you raise rates on the supply side of things, that's inflationary for anybody trying to start a business or borrow money. It dampens you have fewer people with jobs because they aren't expanding because rates are too high. It just seems like it's counterintuitive how it works.
The degree to which the Fed originally misjudged the tenacity of this inflation, as we all know, has really been harmful.
What was it? What caused the inflation, Roger?
I think it was a pandemic myself.
You do? You don't think it's the spending or the
I wouldn't say that has
stimulus
no effect, but I think the primary cause is the pandemic. And if you step way back, the economy stopped. Everyone was at home. Large recycling of stimulus payments or transmission of stimulus payments. Economy starts up much faster than people think. People are at home. They can't spend on the normal things they spend on, going out to eat, travel, hospitality. They have a lot of liquidity because most people retain their jobs and they received these payments, and they couldn't spend on a lot of traditional things. So what did they do? They spent it on goods, especially goods that pertain to the home. Might have been a bicycle, might have been a grill, might have been whatever you can do DIY at home.
Yep.
Demand for certain types of goods was huge, outstripped the capacity on the supply side. You saw inflation on the goods side. It leaked over to the services side, particularly in terms of labor. And to me, that's the main cause of this inflation.